You've got $1,000 available and you're ready to invest. But then the question hits, the same one that stops so many people right at the start. Is it better to put your money in diversified ETFs, which offer security and stability, or should you pick individual stocks with high growth potential even if they come with higher risk? If you've ever faced this uncertainty, stay with me until the end of this video. Today we're going to break it all down with clear analysis, simulations, and side-by-side comparisons, so you can decide which of these two strategies makes the most sense for you, especially if your profile leans toward conservative or moderate. The goal isn't to tell you what to do, but to give you the clarity you need to invest your money wisely, safely, and aligned with your financial goals. Many beginners jump into investing without seeing the full picture. And when you're starting with a small amount, like $1,000, every decision matters even more. On one side, you have ETFs, exchange-traded funds that mirror indexes and give you access to a diversified portfolio in just one move. On the other, individual stocks, direct investments in specific companies that can soar or sink. Each path has its strengths and risks, and choosing the right one depends more on who you are than on what the market is doing. Before you put your money to work, it's critical to understand what these strategies actually deliver. And that's exactly what we're going to walk through now. Let's start with ETFs. When you invest in an ETF, you're essentially buying a basket of assets in a single transaction. It's like gaining exposure to dozens, sometimes hundreds, of companies, sectors, or even countries, all in one click. This instantly reduces your risk. Even if one company underperforms, the impact is softened by the others in the fund. Take the VOO ETF, for example. It tracks the S&P 500 index, which includes the 500 largest companies in the US. With one investment, you're exposed to giants like Apple, Microsoft, and Johnson & Johnson. All of this comes with ultra-low fees and a passive strategy that doesn't require you to check the market every day. Over the last few decades, the S&P 500 has averaged a return of around 10% annually. Steady growth with manageable volatility. If you value consistency, ETFs are one of the most efficient and secure ways to enter the investing world. Now let's look at the other side, picking individual stocks with high growth potential. This strategy requires more research, but it can also deliver returns well above average, especially if you're good at spotting trends early. Let's say you had invested $1,000 in Nvidia 5 years ago, before the boom in AI became mainstream. That capital could have grown exponentially. The same goes for Tesla, which disrupted the automotive industry, or Amazon, which redefined global e-commerce. But here's the key. This kind of investment comes with significantly higher risk. Volatility is sharper, and you'll need to stay on top of quarterly earnings reports, company news, regulatory changes, and market sentiment. It's a more complex game with more moving parts, but one that offers real potential for accelerated growth, if played wisely. Now let's get to the core of this video, a visual and practical comparison between these two strategies. We ran a simulation based on real performance over the last 5 years. Imagine that in January 2019 you invested $1,000 in SPY, an ETF that tracks the S&P 500. After 5 years, that money would have grown to around $1,720, assuming an average return of 10% per year with dividends reinvested. Now imagine you had put the same $1,000 into Apple stock, which grew over 300% during that period. You'd have over $4,000 today. The difference is massive, right? But here's the catch. With higher returns come higher risks. If you had chosen a different stock that looked promising but underperformed, say a tech startup hit hard during the pandemic, your $1,000 could now be worth less than $800. Our side-by-side chart makes it clear. ETFs provide a smoother, more stable growth curve, while individual stocks are more like a roller coaster, thrilling climbs, but also sharp drops. Now that you've seen the numbers, the big question is, which strategy is right for you? And here's where this video delivers the most value, helping you understand your own financial profile. Let's do a quick self-assessment. Do you prefer stability and predictability, even if it means slower growth? Do you lack the time or interest to monitor the market daily? Do you want to diversify even with a small amount of capital? If you answered yes to any of these, ETFs might be the best fit for your current stage. But if you're someone who enjoys researching, companies, has the time to follow financial news, and can handle more risk in exchange for greater reward, then picking individual stocks could be your play. And remember, these strategies don't have to be mutually exclusive. Many smart investors build a foundation with ETFs and allocate a smaller portion of their portfolio to high-growth stocks, combining stability with opportunity. The truth is, investing isn't about finding the perfect asset. It's about building a strategy that aligns with your personality, your goals, and your risk tolerance. For someone starting with $1,000, the priority should be to build the habit of investing. While learning the reasoning behind your choices, you can dip your toes into either strategy, or even both, with that amount. And the great thing is, $1,000 gives you room to make small mistakes and learn big lessons. Use this moment to observe, adjust, and find out how you respond to market movements. In the end, the best investment isn't the one with the highest return. It's the one that keeps you investing consistently without losing sleep at night. If this video helped you gain clarity on where to invest your money, now it's your turn. Let me know in the comments. Which strategy makes the most sense for your profile right now? Are you leaning toward ETFs, getting into individual stocks, or planning to use both? Don't forget to like the video, subscribe to the channel, and turn on notifications, because every week we bring you new content with deep dives, comparisons, and smart strategies to help you invest better, safer, and with more confidence. See you in the next video.